Did you know that working on improving your credit score may be one of the most effective ways to save hundreds of thousands of dollars in your future? In this video, I'll explain the factors that determine your credit score and how you can improve it. Hello everyone, welcome to Vigilant MD, where doctors in training discuss basic financial principles. First, let's make it clear that this video is for educational purposes only, and none of this should be considered as financial advice. I want to start off by telling you a story about John and Sam. John and Sam graduate from a general surgery residency together at the same age. Over the next several years, they save up some money and they both decide to buy identical homes for $800,000 with a 20% down payment. Since John and Sam both pay $160,000, which is 20% of the value of the house as a down payment, they will have to get a mortgage loan for $640,000. Are you following? Now, John has an excellent credit score and was approved for his 30-year fixed-rate mortgage at 3%. Sam, who was also a very hard-working physician, made a few careless mistakes with his money and had a lower credit score and was approved for a 30-year fixed-rate mortgage at 4.5%. Well, that's just a 1.5% difference in interest rate, right? When John is finished paying for his mortgage after 30 years, he would have paid $331,000 in interest, in addition to the principal of $640,000. When Sam is done paying for his home, he would actually end up paying $527,000 in interest, and at the end of 30 years, Sam would have paid $196,000 more for the same exact house, simply because Sam did not have as good of a credit score as John. Now imagine, John and Sam both apply for a $100,000 loan to open up their practice. Then further down the line, they each get an automobile loan, etc., etc., etc. Over the course of their career, Sam will get further and further behind financially simply because he did not keep up with his credit score. Don't be like Sam. Taking good care of your credit score is simple and easy to do if you understand how to do it. Let's start with, what is a credit score? Your credit score is a rating that lenders use to evaluate your credit worthiness. The most widely accepted credit score is the FICO score, with FICO standing for the Fair Isaac Corporation. Your FICO score has a scale between 300 and 850, and the higher the score, the better it is. Although it is not a perfect system, banks and financial institutions will generally view someone with a higher credit score as a more financially responsible, low-risk borrower. How do you check your credit score? To get your FICO score, you will want to get a credit report. In the United States, there are 3 main credit reporting bureaus, and those are Experian, Equifax, and TransUnion. To get your official FICO score, you can go to myfico.com and pay a fee to get an official report. However, these days, there are several websites that provide a credit report for free using their own algorithm. Perhaps the most famous option for free credit reports is through creditkarma.com. I personally use this website, and they actually have a convenient app that you can install on your smartphone as well. Creditkarma.com will update your credit score with the most current information once a week. Another option that you can use is a website called creditsesame.com, and they also have a convenient app you can install on your phone. You cannot improve your credit score if you do not know what it currently is. If you have not recently checked your credit report, go to one of these sites and check your credit report today. What's the scale for FICO scores? As this chart from Experian shows, FICO scores are scaled from 300 to 850, and they are divided into 5 ratings of poor, fair, good, very good, and exceptional. In general, the most favorable mortgage rates are given to those people that have FICO scores above 740. Once you get higher than 740, any additional increase in your score may not result in any lower interest rates. So while continuing to improve one's credit score should be encouraged, the target score for best interest rates should be to aim for 740 or higher. What factors are used to generate a FICO score? Number 1, payment history. This determines 35% of your credit score. This category evaluates what percentage of your payments have been made on time over your credit history. As you can imagine, making late payments and inconsistent payments can be a huge red flag for lenders. This is likely why this section carries such a large portion of the credit score. The percentage of your on-time payments is calculated by taking the number of on-time payments and dividing that by the total payments and multiplying 100. So if Sam has one loan that he has had for 12 months and he makes one late payment, his percentage of on-time payments will be 11 divided by 12 times 100, which will be 91.6%. On the other hand, if Sam had one loan and 2 credit cards and missed one payment, his percentage of on-time payments would have been 35 divided by 36 times 100, which would equal 97%. So if you've noticed something interesting here, having few accounts and missing one payment is potentially more serious than missing one payment when you have many accounts. I'm not saying that the system makes sense, I'm just telling you how it is. Let's say if you have a credit card balance and you don't have the money to pay it off in full, making the minimum payment will actually count as an on-time payment. Now, I never encourage anyone to carry a credit card balance, but if you find yourself in this situation, make sure you at least make the minimum payment on time, or it can damage your credit score. So what action steps can you take in this category? Never allow yourself to make a late payment. Get organized to make on-time payments for every single account. That starts with finding all of your accounts and get all of your login information straight. I know you are busy, but this is important because your inattention today could cost you hundreds of thousands of dollars in the future. Personally, I have a system where basically every single time I get a paycheck, I make all of my payments on the following Saturday. Creating a consistent system of paying off your balances can help you make this process very routine, and it usually takes me no longer than 10 minutes to go through this process. Category number 2, amount owed or credit utilization ratio. And this category will compose of 30% of your score. Credit utilization ratio is the percentage of credit someone is actually using against their total available credit. So let's say you have a credit card that offers you $5,000 in credit and you have a balance of $4,000. Well, you have an 80% credit utilization ratio. That is not good in the lender's eyes. It is generally recommended to keep your utilization ratio below 30%, and keeping it even lower than that is even better. If you always pay off your credit card balance in full by the end of the month, this should automatically take care of this category, and you never have to worry about it. Now, what is interesting is, in the same example above, If that person had 3 credit cards, each with a $5,000 limit, and they were using $4,000, that person's utilization ratio would actually only be 26%, which would be much better than the 80% from before. Once again, it seems like the first person with only 1 credit card would be seen as more responsible, but that's not how credit scores work. In fact, the person with multiple accounts of credit with a larger total available credit will always have a lower credit utilization ratio. Once again, I don't make these rules. I'm just the messenger. Now in the scenario above, where there were 3 credit cards, it is actually better if this person spends the $4,000 divided in those 3 accounts rather than having it all on 1 account for the credit score. This is because your credit score will examine your utilization ratios for each individual account and the total utilization ratio across all available credit. So action steps to take in this category is keep your utilization ratio as low as possible, preferably lower than 30%. Make it an absolute principle to pay off your balances off completely, every month down to 0. And then also consider opening a new credit card without an annual fee to increase your total available credit to improve your utilization ratio. Lastly, don't put all of your spending onto 1 credit account if you can avoid it. Third category, average length of credit history, and this is 15% of your score. This category is pretty self-explanatory. The longer your credit history is, the better. This is where opening up a credit card and responsibly making on-time payments during residency can help build your credit score. Even if you rarely use it, making consistent payments throughout the 3 to 5 years of your residency will tremendously improve your average length of credit history. One crucial mistake that people can make in this category is canceling the oldest credit card that they have that they no longer use. It seems like closing an old credit card you no longer use would be viewed as a responsible thing to do. But from your credit score's perspective, this will be one of the biggest mistakes you can make. Let's say you have 1 credit card you had for 10 years and another credit card you had for 2 years. Right now, your average length of credit is 10 plus 2 divided by 2, 6 years. If you close the old card though, your average length of credit will suddenly become 2 years. And boom, your credit score will drop a significant amount. I have actually seen someone try to close one of their credit card accounts right before they applied for a mortgage, which plummeted their credit score. So what I tell people is, don't close your old credit cards if they do not have an annual fee. Once a year, just buy a cup of coffee or a pack of gum with it to keep that account open to preserve your credit score. So action steps to take in this category, start to build your credit history as soon as possible. If you have no need for a loan and you don't have any credit cards, you should seriously consider opening up a credit card with no annual fee and build your average length of credit history. Lastly, don't close your oldest no annual fee credit cards if at all possible. Category 4, credit mix or types of credit used, and this is 10% of your total score. This section examines the mix of credit that you have, such as credit cards, student loans, auto loans, and mortgages. It does not make a lot of sense to me why a lender perceives someone who has taken out many different types of loans as more creditworthy, but it does show them, I guess, that you are capable of managing multiple types of credit and are still able to make reliable on-time payments. Action steps in this category, I would say there's not much to do here because you should not take out loans that you don't need. Once again, if you have no loans and you have no credit cards, I would seriously consider opening one. Category number 5, new credit or credit inquiries, and this is 10% of your score. Every time you apply for another loan or credit, the lender will check your formal FICO report, and that is known as a hard credit inquiry. Having too many hard inquiries in a short period of time may be seen as a red flag to lenders because they may get concerned that you have run out of money and you are looking for multiple lines of credit to get by. A hard inquiry will remain on your credit report for 2 years. The FICO score will actually only take into account hard inquiries within the last 12 months, but your report will reflect 2 years worth of inquiries. It is true that each hard inquiry will temporarily drop your credit score, but there is something important that you should know about this. Let's say you are looking for a mortgage and you apply to multiple companies to find out who is willing to offer you the best interest rate. For being responsible and rate shopping, you shouldn't be penalized for that, right? Thankfully, you are correct. In order to encourage consumers to shop for the best interest rates, multiple hard inquiries that are completed within a 45-day period for the same type of loan will usually be bundled as one hard inquiry in your credit report. Now that's one thing that the credit scoring system does that actually makes sense to me. Action steps for this category. So do not open several new credit accounts in a short period of time if you can help it. This is especially important when you're preparing for a mortgage application. When you're comparing for rates for loans, combine multiple inquiries within a 45-day or less. In summary, never allow yourself to make late payments, keep your credit utilization low, and consider opening a no annual fee credit card. Lastly, do not close old credit cards if they do not have an annual fee, and start this credit building process as early as possible. Thank you guys again for watching to the end. If you enjoyed this video, please smash that like button and hit the subscribe button down below. If you have any questions about credit scores or credit reports, leave me a comment down below and I will get back to you as soon as I can. See you guys on the next video.